Hello guys, this is your modern day spokesman and welcome back to the channel. If you are new, welcome. Please don't forget to subscribe so that you don't miss out on future tutorial videos. Now guys, today we're going to be looking at a very important aspect of taxation, which is capital gains tax. So by the end of this tutorial, you'll be able to define what a capital gains tax is, the basic calculation, and some of the important regulations or rules surrounding capital gains tax. So now, capital gains tax, formally, it's actually a tax on capital gains that arises when you dispose of an asset on or after 1 October 2001. So this is what they call the valuation date, 1st of October 2001, for proceeds that exceed its base cost. So, for example, if the proceeds, you sell an asset for 400,000 and your base cost is 275,000, there is a capital gains of a capital gain of 125,000. So this is the basic form of the calculation, but it goes into a bit of detail. Now, let me remind you while we're still on this part. This is just part 1 of 3 videos, right? Yeah, I'm just going to be giving you the introduction, like I said, some of the important rules and regulations around capital gains tax. On part 2, I'm going to get into detail for assets that were bought before 1 October 2011, and on part 3, we're going to do assets that were bought on 1 October or after that, right? So another important thing to note is that capital gains tax applies to individuals, trusts, and also companies. And a resident, as defined in the Income Tax Act of in the Income Tax Act 58 of 1962. Sorry about that. Okay, so this resident, in terms of this act, is also liable for capital gains tax on assets located both in and outside of the country, in this case, South Africa. So in the case of a non-resident is liable for capital gains tax only on immovable property in South Africa.